Good evening and welcome everybody. My name's Brittany Williams and I'm going to introduce you to Wesley Oliver. He's our presenter for tonight and he works at Broadview Mortgage. I'm going to introduce him in just one moment. For now, I'm just going to give a little introduction as to who he is. He is going to present tonight how to remove private mortgage insurance or FHA mortgage insurance. Wesley is a senior loan officer with Broadview Mortgage, and his presentations are very detailed and very eye-opening. So I'm confident that all of you will be getting a lot out of the time that we have together tonight. Private mortgage insurance is an extra expense for most homeowners. So tonight, Wesley will discuss how to get rid of that expense and free up some money for savings. So who doesn't want more money, right? That's why Wes at Broadview Mortgage finds it so necessary to educate as many people as he can on how to drop PMI. We want all of you to realize that your financial goals are realistic. So I'm going to let Wesley take it away. We've been waiting for people to get on the call, and I think enough time has passed. So Wesley, go for it.
Good evening, everyone, and thank you so much for joining us here on, I'm sure, what is a busy work week, and I'm sure you all had busy days at work, and you're looking forward to relaxing. So I do appreciate you guys joining us here tonight. First and foremost, I always like to start off my presentations with giving you a little information about Broadview Mortgage in general. Though some of you may have heard of us and some of you may have come in contact with us at some point before, there's quite a few people who may not know who we are. So first and foremost, we have 26 years of purchase market experience, and of course that includes refinances as well, but we find ourselves particularly geared toward the purchase market. We are a direct lender, which means we can process, underwrite, fund, and service our own loans. We've been ranked as one of the top 100 lenders in America for the last couple of years by Mortgage Professional Magazine. And our goal is to educate, create, and empower homeowners. So that is why we take the time to do these things at least a couple times a month. There's a lot of misinformation flying around always, and it's just very beneficial to be able to connect with people and give them the truth. So this is all about how to remove mortgage insurance, basically. And let's take a look at some of the basics of mortgage insurance. First and foremost, mortgage insurance is unique because it's one of the few types of insurances you'll pay for where you're not the benefactor. Mortgage insurance exists solely for the protection of the lender in case you default or stop making payments on the home. Secondly, this one's really important. As of this year, mortgage insurance is no longer tax deductible. And that's a big deal because as far as a homeowner, now that that is officially not tax deductible, there's really no benefit for someone in your situation for paying mortgage insurance, or as I like to put it, there's really no nutritional value for you as a homeowner in paying for mortgage insurance. Mortgage insurance differs or varies depending on what type of loan you have or what type of loan program you're dealing with, and most people are accustomed to the fact that it's usually with a conventional loan, and it's whenever you purchase a property and you put less than 20% down or you have less than 20% equity in the property. With private mortgage insurance, which is specific to conventional loans, you have a rate that is borrower specific, and what that means is it's a lot like dealing with car insurance or shopping for car insurance. It takes into account your specific set of variables, how much you're putting down, what your credit score is, what your debt-to-income ratio is, things like that, and that's how we arrive at what your private mortgage insurance payment will be, or your premium. And also, like car insurance, you can use different companies, and there's a competitive market out there for private mortgage insurance. And then, of course, everyone's familiar with the fact that in most cases, it's an automatic termination for private mortgage insurance at 78% loan to value. And keep in mind that that 78% is based on the amortization or schedule of payments from when you start paying on that mortgage. And I'll show you a chart on that a little later that'll give you a better illustration of that. So requirements for termination, first and foremost, you have to have a good payment history. So if you've had 3 to 5 mortgage lates in the last year, regardless of where your DTI is, regardless of where your LTV is or your loan to value, they're not just going to cancel that for you because you're the prime reason they would want mortgage insurance if you're having trouble making or keeping up with your payments. Also, you have to demonstrate that the value has not declined below the original value. So, of course, you don't want to be upside down or underwater, and a lot of that has nothing to do with you. That's just, determining and deciding market factors wherever your home is located. Also, they're going to want certification that equity is not subject to a subordinate lien. So if you're someone that has a second mortgage, even if you get the mortgage paid down to, let's say, 80% loan to value, but you still have a second for about 10% of that value, that's going to create an issue for you as well. So what are some of the solutions for getting rid of the mortgage insurance? And first and foremost, you can do it the old-fashioned way, which is just to make your payments on time every month and wait it out based on the amortization schedule. Secondly, the one that most people are familiar with is you can simply refinance. So if you feel that you have enough value in your current property to the point where if you were to refinance for the same amount that you owe currently on the property, based on that, you would be able to avoid mortgage insurance because you would have that 20% equity. So if you owe $400,000 on your current mortgage and your property is now valued at $500,000, if you were to refinance back into a $400,000 loan, based on that value, that assessed value, you would be able to get the new loan without having to worry about the burden of mortgage insurance. One of the more unfamiliar ways and one of the more difficult ways to do it is to upgrade your home, do things to create more value in your home. Maybe you could do additions, things like that. And that's really a situation where you're hoping that you can increase the value of your home, and therefore that bump in value compared to what you own the loan right now will get you out of the woods. So the next step is you could do layered financing. And layered financing would basically be a situation where you bring in a second lender. So your primary lender would finance 80% of the mortgage, and then you would have a second lender, say, finance 10%, and then the equity of 10% in the mortgage would be enough to help you avoid private mortgage insurance. You can also accelerate your payments toward principal. So if you were to pay an additional $500, $1,000, whatever, what have you, toward principal in addition to your normal mortgage payment every month, then that would also help you get rid of that mortgage insurance a lot faster. And then, of course, you can always have the value reappraised on the property after you've had the loan for at least 2 years. The mortgage company is obviously going to choose an appraiser of their selection, and they're going to have them reassess the value. And at that point, you can, if the value's there based on the appraisal, you can request that they remove it as well. So here's an amortization schedule, and this is very important because a lot of people are unaware of exactly how long it's going to take to get the mortgage insurance removed through just making your payments in the amortization schedule. A lot of people in their heads think that it's going to take about 5 years. And what they don't realize as you're looking at the chart, when you initially purchase a home, you're starting off with most of your payment going toward interest and not the principal. So as you look at the chart, as you look at the columns far right on interest payment and principal payment, specifically the principal payment, if you look at year 1, you have $225 a month going toward principal. Year 2, it doesn't change much, only $237. Year 3, $252. So if you look at the first arrow, let's say you're starting with the balance of $226,000 on your home loan. Well, at 80% or 78%, let me say, you're going to have to be at about $180,000 on that current loan. So if you look at the second arrow, as well as the bracket on line 12, this individual with a 6% interest rate, it's going to take them 12 years to pay that balance down just by making their normal mortgage payments. Now, of course, we know interest rates are not quite that high at this point. You may have an interest rate that high. You may have had your mortgage for quite some time, but if you're at 5% or 4%, even someone who's at the low 4% range, they're still going to be looking at about 9.5 years just making scheduled payments. So that pretty much covers your options when it comes to dealing with a conventional loan as far as getting rid of your mortgage insurance. So the other type of loan most people are familiar with are FHA loans. And FHA loans, the terminology is really a mortgage insurance premium. So you have your upfront mortgage insurance premium, which is financed into the loan, and then you have your annual mortgage insurance premium. And that's a standard rate based on the purchase price. The current rate is 1.35% annually, and if you got your loan a couple years ago or 3 years or 4 years ago, they changed that rate, and that rate continued to increase, I believe, about 6 times in a row over the course of the last few years. So you may be paying a little less than 1.35% depending on when you got your loan, but currently the rate's 1.35% of your purchase price annually. And that rate is set by the Federal Housing Administration. So again, that's one of the contrasts or the differences between traditional mortgage insurance and what you have with FHA. Traditional is based on your set of circumstances and you as an individual, and FHA, it doesn't matter who you are, your rate is going to be 1.35% of your purchase price, and it's going to be paid out annually over 12 months. And with FHA, you don't have a situation where you can go back and say, well, I think the property value's increased on my loan right now. They use the last known value to determine your property value. And what that last known value is, it's probably going to be based on the appraisal from when you got the loan. So whether you purchased it or you refinanced it, it's going to be based on that appraisal value. And you can't say, well, the property's gone up, look, let's do another appraisal. Doesn't work like that. So the requirements for termination, of course, again, same thing, good payment history. Again, you have to make sure that the value is not declined below original value. Certification that the equity is not subject to a subordinate lien. Here's where it's different from traditional mortgage insurance. You have to have had the loan and paid into mortgage insurance for at least 60 months or 5 years. And unfortunately, when I used to speak with clients who had gotten to an FHA loan and we used to speak about their mortgage insurance, they were under the impression that they only had to pay the mortgage insurance for 5 years. But that's not how that works. You have to pay for it for a minimum of 5 years. But if you're just making your standard mortgage payments based on the amortization chart we looked at before, you're probably not going to be getting rid of that mortgage insurance for at least 9 to 10 years. So solutions for removal, here's where it differs. If you got your loan, your FHA loan, prior to April of last year, you can either refinance or you can still accelerate your payments by paying down your principal faster. Here's the kicker though, and here's where it really hurts. If you purchased a home using an FHA loan after April of last year, your only option is to refinance, because now, and let me just correct myself and throw an asterisk out there, we're speaking of a 30-year mortgage. So if you purchased an FHA or you purchased a home using FHA financing after April of last year and it's a 30-year fixed mortgage, your only option is to refinance. And that's because last year they changed the rules on the mortgage insurance with FHA to where it's for the life of the loan now. So it doesn't matter how much you pay down the balance, how much equity you have in the property. If you still have an FHA loan, you're going to be paying mortgage insurance unless you refinance. And and I think part of that, I know a lot of people are asking, why is that? Why did they change that? And I think one of the major reasons for that is simply FHA's lending guidelines are a little more lax than you would find with Fannie or Freddie guidelines. So they're actually taking more risk. FHA is going to allow someone to finance a home just 2 years after a bankruptcy, just 3 years after a short sale or foreclosure. They're also going to allow you to have a higher debt-to-income ratio. They also require that you put less down than you would on a conventional. So they're really taking more risk than you would see with, conventional or traditional financing through Fannie or Freddie guidelines. So that's basically the ins and outs of mortgage insurance. So really, what the next step is, first and foremost, I would say if you're paying mortgage insurance right now, where you should start is, you should probably give a lender a call. I get clients all the time who call in regarding this, and you're welcome to give me a call. And where we start is for a personal mortgage insurance analysis. So the first thing we want to do is we want to determine the property value. So basically working with different software that has the up-to-date sales in your particular area, and it'll give me both an average and a median value for recent property sales. It'll really help us determine what type of value you might have in your home, and therefore where you might be as far as equity. Secondly, you're going to want to do a mortgage insurance review. And what I typically do with that is I'll have someone send in their mortgage statements, and I have an amortization calculator, and I'll plug in all the different factors for their mortgage, and it'll tell me the exact date of when their last payment will be for them to be able to drop the mortgage insurance on their home. So if you're just a couple years away, then it may make sense to wait it out or to try to find a way to, like I said, really pay more toward principal and speed up the process of getting rid of that mortgage insurance. But if not, then we have to start looking at what you could do and what may or may not make sense. And so the last part of that is to just basically do a cost-benefit analysis. And, that would be based on, should you do things to improve the value of your home, which, is kind of risky, or should you go down the path of refinancing? Would it make sense with whatever the cost of the refinance is, what your new interest rate would be, things like that. And I will say this, just in closing, especially with people who are paying FHA mortgage insurance. It's not uncommon after we take a look at the numbers, it's not uncommon for someone with a lower rate right now with FHA to be able to switch over to a conventional mortgage to drop the mortgage insurance and actually take a higher rate with a conventional mortgage rate right now and save money every month. So you might have a rate of 3.875% with your FHA loan right now, and if you were to switch over to a conventional, your rate might go up to 4.25. But with that being said, because the mortgage insurance is usually much higher with FHA than it is with conventional, you still may be able to save a substantial amount of money in your monthly mortgage payment. And not to mention, now that we know, like I said, as of this year, your mortgage insurance is no longer tax deductible, but your interest still is in most cases. So it can still make sense to maybe take a little bit of a higher rate to get rid of your mortgage insurance as opposed to sticking with what you have right now. And if you purchased your home with an FHA mortgage, like I said, after April of last year, it's going to make 100% sense, because that means if you don't, that means you're going to be making 360 payments toward mortgage insurance, and it's not going to serve any purpose or any benefit for you at all. It's just an extra bill every month and basically just taken away from your discretionary income every month. All right, Brittany, I'm going to pass it back over to you for questions and answers.
Sure. Thank you so much for that presentation, Wes. I'm sure everyone learned a lot. And something that I did not say in the beginning of this presentation, I should probably include it now. But for those of you who have been listening and do have questions with regards to the topics that Wesley covered, everyone should have a box in their right-hand corner with a tab labeled questions. So make sure that that tab is open, which means that the arrow is pointing down. And you can type in and submit your questions for the presentation, and I will read them out to Wes, and Wesley will answer them. So hopefully we will get to all of your questions today, and if not, please email Wesley. His email is up on the screen right now, wesley.oliver@broadviewmortgage.com, and he will absolutely respond to your question, whatever that may be, and possibly schedule some time to speak over the phone or in person. So with that being said, I'm going to take a look at the questions that we have. And let's see, our first question is, can I reduce my PMI with Broadview Mortgage if I have a loan with another bank?
Yes, if that were the case, then you would definitely be going the route of refinancing. So like I said, the first step would be for us to take a look at your specific financial situation with your mortgage and your mortgage insurance and make sure that it's going to make sense for you. And then once we can determine that, then yeah, we would basically, provide you with a new loan, pay off your old loan, and with enough value in the property, then you would be able to get rid of mortgage insurance.
Okay, so the next question is, what if I have a 580 FICO score but good payment history on my mortgage? Will I still be able to reduce or get rid of my PMI?
It depends on how you're going about getting rid of the PMI. If you have more value and you want to contact your current lender and have them reassess the value for you, then your credit score probably shouldn't come into play. If you're looking to refinance, we basically have to take a look at the whole situation and figure out, whether or not you qualify for that, or at this time, let me say, and then if not, we would have to figure out how to get you to a point where you would qualify.
Okay. And the next question, can I refuse private mortgage insurance if I'm a first-time home buyer?
Well, you don't really have to refuse it. But there's only two ways you're going to get around it as a first-time home buyer. So the first option is going to be to put 20% down of the purchase price, and your second option is going to be to do what I described as layered financing. We offer that here. We call it an 80-10-10 loan. So what you would do is you'd have to be able to bring in at least 10% as a down payment, and we would finance 80% for you, and then we have another lender that would be able to provide you a home equity line of credit for the additional 10%.
Okay, good to know. And then another question, how can I determine what exactly my property is worth?
There's a lot of different websites out there, Zillow, Redfin. The only problem is a lot of those seem to be overvalued and sometimes undervalued. If you like, anyone's more than welcome to contact me at any of the numbers there, my email address, and like I said, I have more accurate information because I'm using resources provided through title reps that I work with. So it has much more accurate information. And then also, I would say just kind of pay attention to what's going on in your neighborhood. So if you see homes in your neighborhood that are for sale, just kind of keep an eye on them and see what they're selling for.
Okay, so that same person asked, how can I know whether I'm underwater or not?
Really the same thing. Like I said, if you like, you can contact me and I will help you assess the value of your property. Otherwise, you can pay for an appraisal if you want to, and an appraisal will generally cost you anywhere between $300 to $500. So you can do an appraisal, or, like I said, you can just kind of try to piece it together and do some research on homes in your area that have recently sold and kind of figure it out that way.
Okay. Next question. Do I have to refinance in order to drop my PMI, or can I drop my PMI without refinancing?
If you're talking about traditional or standard conventional mortgage, you don't have to refinance to drop your PMI. That's just typically the fastest and let me say the most consistent way to do it. Like I said earlier in the presentation, you can try to have your mortgage company reassess the value and get an appraiser out there and pay for the appraisal. You can do it that way. If you want to try to add value to your property and do the appraisal, you can do it that way, or you can just pay more toward the principal every month and do it that way.
Okay, so it looks like those were all of our questions for now. If anyone else has a question, please type it in now, or forever hold your peace. No, I'm just kidding. Or just call Wes and email him if you'd like. So I think that concludes our webinar presentation for tonight. Thank you, everyone who attended. And Wes, do you have anything else to say?
No, just thank you all again for joining us this evening. Like I said, if you are paying mortgage insurance, definitely take a look at it. It's really taken away from your discretionary income, and like I said, it doesn't really benefit you very much. So if you need help with that, if you want any information, any additional information, or you'd like me to assess the value of your property for you, feel free to give me a call, email me, what have you, and I would be more than happy to do it. So again, thank you and have a great evening.
Oh, Wes, I believe we actually have one more question. It looks like someone just joined us a few minutes ago. And for that person, we will be recording this webinar and we will be putting it on YouTube. So look out for that on our website. And also, Wes's contact information is there. So he can also email you a recording of the webinar. So just for everyone's information, not just the person who just joined us. But the question that we have is, how long do you have to keep PMI insurance?
You have to keep the PMI, and well, if you get your loan to value down to 80%, then at that point you can request that your lender remove the PMI. And if for some reason they don't, at the 80%, thanks to the Homeowner Protection Act, they're going to have to remove it once you pay it down to 78%. So at 78%, it's automatic. At 80%, you can request it.
Okay. Any more questions? Alrighty. I think that finally concludes it. Well, thank you, everyone, and have a great night.